If you're looking to generate monthly income from your investments in 2025, there are exactly 7 proven methods that actually work. And I'm about to show you all of them with real numbers, real risks, and real tax implications. Most people only know about dividend stocks, but that's just scratching the surface. Welcome back, everyone. I'm Alex Sterling from Money Street 101, and today I'm giving you the complete roadmap to monthly income investing. We're covering dividend strategies, bond investments, real estate options, high-yield accounts, business income, and even some advanced strategies that most people never consider. Here's what's different about this video. I'm giving you the brutal truth about taxes, fees, and realistic income expectations for each method. No fluff, no unrealistic promises, just honest numbers, so you can make smart decisions about your financial future. By the end of this video, you'll know exactly which income strategies match your situation and how much money you actually need to get started. Let's dive in. Let's start with the safest option: high-yield savings accounts and CDs. These aren't sexy, but they're the foundation of any income strategy because they're FDIC insured. In 2025, the best high-yield savings accounts are paying 4.5% to 5% APY. That means $100,000 generates about $4,500 annually, or $375 per month. The pros: it's completely safe, liquid, and there are no fees at most online banks like Ally, Marcus, or Discover. The cons: inflation eats into your purchasing power over time, and interest rates can change. Also, this income is taxed as ordinary income, so if you're in the 24% bracket, your real monthly income drops to about $285. CDs work similarly, but lock up your money for 6 months to 5 years in exchange for slightly higher rates. Right now, 12-month CDs are paying around 5.25%. Who this is for? Anyone who wants guaranteed income and can't afford to lose principal. This should be your first $25,000 to $50,000 before you consider riskier investments. Think of it as your income foundation. Next up, Treasury bonds and government securities. These are loans to the US government, and they're considered the safest investments in the world after cash. Treasury I bonds are paying 4.28% as of 2025, and they adjust for inflation. The catch: you can only buy $10,000 per year, and you can't cash them out for 12 months. But for long-term income, they're fantastic because they protect against inflation. Regular Treasury bonds are more flexible. You can buy 2-year, 5-year, 10-year, or even 30-year bonds. Current yields range from 4% to 4.8%, depending on the term. The income is exempt from state taxes, which is a huge advantage if you live in a high-tax state. The pros: guaranteed by the US government, predictable income, state tax advantages. The cons: if interest rates rise, bond values fall. And like savings accounts, the income is federally taxable. Who this is for? Conservative investors who want predictable income and don't mind tying up money for several years. A $100,000 investment in 10-year treasuries generates about $4,400 annually, or $367 per month. Now we get to dividend investing, probably the most popular monthly income strategy. But here's what most YouTubers won't tell you: taxes and fees can kill your returns if you're not careful. The best approach for most people is dividend-focused ETFs like SCHD or VYM. These typically yield 2.5% to 4% annually and give you instant diversification. SCHD has returned about 10% annually over the past decade when you include dividend reinvestment. Individual dividend stocks can yield higher. Think companies like Coca-Cola, Johnson & Johnson, or Realty Income. But you need to research payout ratios, debt levels, and business sustainability. Never chase yields above 7% to 8% without understanding why they're so high. Here's the tax reality. Qualified dividends are taxed at capital gains rates, 0%, 15%, or 20%, depending on your income. But you need to hold the stock for at least 60 days to qualify. REITs and some international stocks pay non-qualified dividends taxed as ordinary income. The pros: potential for dividend growth over time, some tax advantages, liquidity. The cons: dividends can be cut, Stock prices fluctuate, and you need significant capital for meaningful income. Realistic numbers. 1. $100,000 in dividend ETFs yielding 3.5% generates $3,500 annually, or about $290 per month, before taxes. REITs let you invest in real estate without becoming a landlord. They're required to pay out 90% of their taxable income as dividends, which typically means yields of 3 to 6%. There are different types. Retail REITs own shopping centers, residential REITs own apartments, industrial REITs own warehouses, and healthcare REITs own hospitals and medical facilities. Each has different risk profiles. The easiest way to invest is through REIT ETFs like VNQ or SCHH, which give you exposure to the entire REIT market. These typically yield 3 to 4% and have lower volatility than individual REITs. But here's the tax gotcha. Most REIT dividends are taxed as ordinary income, not the favorable capital gains rate. So if you're in the 24% tax bracket, a 4% REIT yield becomes 3.04% after taxes. This is why REITs work better in tax advantage accounts like IRAs. The pros: exposure to real estate, typically higher yields than dividend stocks, professional management. The cons: interest rate sensitive, ordinary income tax treatment, can be volatile during economic downturns. $100,000 in REIT ETFs, yielding 4%, generates $4,000 annually. But after taxes, it might only be $3,040, or about $253 per month. Direct rental real estate can generate excellent monthly income, but it requires more work and capital than most people realize. The typical rental property generates 6 to 12% annual returns when you include appreciation, but the cash flow is usually much lower. A $300,000 rental property might generate $2,400 monthly in rent, but after mortgage payments, taxes, insurance, maintenance, and vacancy allowances, your actual cash flow might only be $200 to $400 per month. The advantages are significant. Leverage: you can control a $300,000 asset with $60,000 down. Tax deductions for depreciation and expenses, and potential appreciation. Plus, rental income isn't subject to Social Security and Medicare taxes. The disadvantages: you're a landlord dealing with tenants, repairs, and vacancies. Properties can sit empty for months. Major repairs can wipe out years of cash flow. And if you need to sell quickly, real estate is illiquid. Who this is for: people who want to be actively involved in their investments and have enough capital for proper diversification. Don't buy just one rental property. That's concentration risk. You need multiple properties or enough cash flow from other sources to handle vacancy periods. Realistic expectation: plan on 1 to 3% annual cash flow on your total investment, not the inflated numbers you see on social media. Here's the income source with the highest potential, but also the highest risk. Business income. This includes everything from freelance work to creating digital products to starting a service business. The advantages are huge: unlimited income potential, tax benefits through business deductions, and you control your own destiny. Many of the wealthiest people I know built their wealth through business income, not investments. Some realistic examples: freelance writing can generate $2,000 to $5,000 monthly, depending on your skills. Online course creation can generate $1,000 to $10,000 monthly once established. Service businesses like consulting, coaching, or local services can scale to 6-figure annual incomes. But here's the reality check: most businesses fail within the first few years. Success requires skills, time, marketing, and often upfront investment. The income is usually inconsistent, especially in the beginning, and you're paying self-employment taxes on top of regular income taxes. The key is starting small while keeping your day job. Validate your idea before quitting your main income source. Build systems so the business can run without your constant involvement. Who this is for: people with marketable skills who are willing to trade time and effort for potentially unlimited income. This isn't passive income, it's active income that can become semi-passive over time. Let's quickly cover 2 advanced strategies that can boost your income but come with additional complexity. Covered calls involve selling call options on stocks you own to generate extra income. ETFs like JEPI and QYLD use this strategy and typically yield 7 to 12%. The income is consistent, but you cap your upside potential if stocks rise dramatically. Peer-to-peer lending through platforms like Prosper or Lending Club can yield 5 to 8%, but default risk is real. You're essentially acting as a bank, lending money to individuals or small businesses. Some investors love the steady payments, but you can lose your principal if borrowers default. Both strategies require more research and understanding than basic dividend investing. They're not suitable for beginners or people who can't afford to lose money. The tax treatment varies. Covered call premiums are usually taxed as short-term capital gains, while peer lending income is taxed as ordinary income. My recommendation: don't allocate more than 5 to 10% of your income portfolio to these advanced strategies until you have at least $100,000 invested in more traditional approaches. They're supplements to your core strategy, not replacements. Now let's put this all together into actual portfolio recommendations based on your situation and risk tolerance. For beginners with $10,000 to $25,000, start with 60% high-yield savings, 40% dividend ETFs in a Roth IRA. This gives you safety plus growth potential. Monthly income: $30 to $75, depending on your total investment. For intermediate investors with $25,000 to $100,000, 30% high-yield savings in CDs, 40% dividend ETFs, 20% treasury bonds, 10% REIT ETFs. This balances safety with higher yields. Monthly income: $75 to $350. For advanced investors with $100,000 plus, 20% cash and CDs, 35% dividend stocks and ETFs, 25% bonds and treasuries, 15% REITs, 5% alternative strategies. Monthly income: $350 to $600 from a $100,000 portfolio. Key principles for any portfolio: diversify across different income sources. Consider tax implications. Keep some money liquid for emergencies. And don't chase yields without understanding risks. Remember, these are starting allocations. As you gain experience and knowledge, you can adjust based on your comfort level and changing market conditions. The most important thing is to start with what you understand and gradually expand from there. Before I give you my final recommendations, let's set realistic expectations about monthly income investing in 2025. First, you need significant capital for meaningful income. To generate $1,000 monthly, $12,000 annually at 4% yield, you need $300,000 invested. Anyone promising significant income from small investments is either lying or promoting extremely risky strategies. Second, income fluctuates. Dividends get cut, interest rates change, tenants move out, businesses have bad months. Never rely on investment income as your only income source, unless you have substantial reserves. Third, taxes matter enormously. A 5% yield becomes 3.8% after taxes if you're in the 24% bracket. Always calculate after-tax returns when comparing options. Fourth, inflation is your enemy. A fixed $500 monthly income becomes worth less every year. Focus on income sources that can grow over time, like dividend growth stocks or rental properties with lease escalations. Finally, avoid these common mistakes: chasing high yields without understanding risks, putting all your money in one income source, ignoring tax implications, and expecting immediate results. Building substantial investment income takes time, patience, and consistent contributions. Start with what you can afford, reinvest your income in the early years, and gradually build toward your monthly income goals. Here's my action plan for you. First, start with high-yield savings for your foundation. Second, open a Roth IRA and begin investing in dividend ETFs. Third, educate yourself about one additional income source that interests you. Fourth, set a realistic timeline. Plan on 5 to 10 years to build substantial monthly income. Which of these income strategies interests you most? Drop it in the comments and let me know what specific topics you'd like me to dive deeper into. I'm planning detailed videos on each of these strategies, so your input helps me prioritize. If this comprehensive overview helped you understand your monthly income options, smash that like button and subscribe to Money Street 101 for more honest financial education. Remember, there's no magic bullet for investment income. It takes time, patience, and smart decisions. But with the right strategy and realistic expectations, you can build a monthly income stream that supports your financial goals. I'll see you in the next video where we'll dive deep into one of these strategies. Until then, keep learning and keep building your financial future.